All things being equal, if people think that it's not necessarily the main driver of inflation, it should be a positive for the economy. But David, what would you have to see either in this report or elsewhere to change your view, which is right now what the market believes, that the Fed is going to turn around and cut rates because there is going to be this incredible disinflation?
It would take a lot to change my view, because we look at all the little pieces of inflation. We have to forecast this number, and it's a bear to forecast it. So we look at all the little pieces. And what we see is this pressure coming off energy prices globally, food price inflation in pipeline. I think it looks like disinflation. We're not, and we've got all these worries about potential recession, which I think is keeping down inflation elsewhere. So I see the economy gradually normalizing here. And our numbers say, okay, so today it's going to be about 5% year over year, not much change from last month. But a year ago in May, inflation was 0.9. In June was 1.2%. And when you back those numbers out, that means that the CPI headline inflation rate will be below 4% by June. We're pretty confident. We think it's going to be about a 3.8, 3.7 by June, and then it'll sort of flatline, and then it'll come down all the way through 2024 as shelter goes the other way. So we're modeling all the pieces of this, and it would take a lot and it's really been tracking very close to our models, throughout the last year, even though it peaked at a very high number. So it would take a lot to convince us that we're on the wrong path here.